Hello and welcome to this Monday's weekly morning market briefing. We've got lots to talk about, but firstly, artificial intelligence companies seek big profits from small language models, as well as that the dollar rally falters as in falling inflation raises hopes of rate cuts, and finally, Gantz threatens to quit Israeli government if no new war plan by June the 8th. Got lots to talk about in the charts. Also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with AI. Now, AI companies have now spent billions of dollars on building new AI language models in an effort to power new generative AI products with the aim to generate huge revenues. This comes as key tech giants such as Apple, Microsoft, Meta, and Google have all released new AI models with fewer parameters but still powerful capabilities. Now, this kind of AI revolution, this new AI drive, this new drive to produce and generate the best language model, AI language model, is of course something that we've been covering greatly recently, as things have really been heating up within the race to produce the best one, with both Meta, Google, and Microsoft all kind of bringing their own kind of unique selling point to the market and really bringing their own strengths to developing their own AI language models. And we've known for quite some time now, or at least we've been expecting the latest release of the new AI language models that we're now seeing being implemented by both Microsoft and Google. As this has kind of been the thing that these tech giants have been kind of hinting to and saying that we are going to receive within the next few weeks. As you know, both Meta, Google, and Microsoft have all said, at least a few weeks back now, they all said that new AI models are to be deployed within the coming weeks, and now we're starting to see that with ChatGPT and OpenAI with their latest GPT-4 4.0 model, and now also Gemini 1.5, I believe. So new language models are already now being deployed in an effort to kind of win this race, which is looking to be never ending really. But ultimately, they've all been bringing their own strengths. However, there's certainly been some tech giants which we might expect that would bring really serious strengths to the market, but ultimately we just haven't seen them kind of deploy anything to do with the AI industry just yet, or really make a stab at the kind of AI market as other tech giants are doing. And this is despite their kind of unique strengths and abilities to maybe deploy such AI models, which would completely compete with something like Microsoft, Meta, or Google. And the key tech giant that I think of when we talk about that kind of stuff is of course Apple, which despite having great access to the consumer market through their iPhone and other Mac related products, of course has really struggled to make a difference or make a kind of jump into the AI industry, and really has lagged behind as a result, with shareholders really demanding some change from Apple and demanding some progress, and we just really haven't seen that just yet. As a result though, of course, as we've noted over recent weeks, Apple has implemented, or at least is trying to now implement, a new AI development team, building bases in both Zurich as well as, in the US, by hiring out a great deal of AI developers, or at least buying out a great deal of AI developers from the likes of Google especially, but also other tech giants, as this is ultimately the effort by Apple now to kind of branch into this AI industry and utilize the kind of things that these language models are providing to key businesses. Ultimately though, as we've noted many times, these AI models are also kind of limited in some sense, and certainly some businesses have found issues to do with the kind of way that they need to run these language models. And a key thing that we've been noting the entire time is the fact that these AI language models are going to require a great deal of energy, a great deal of power, and also a great deal of computing power. So, on the side of needing the latest GPUs, CPUs, and that kind of thing. And as a result of that, we have seen certain businesses respond, but we've also kind of heard some really pessimistic outlooks from certain individuals, especially from the oil industry, which have said that basically, this AI revolution is basically going to shut down that entire green revolution, because the power required, the power needed to generate or build or even just use these language models is going to require far more than the kind of green industry can provide. And we've heard also from the computing sector that these chip manufacturers are working extremely hard to generate chips which are going to be compatible and useful to these language models. As recently, of course, the NVIDIA kind of AI focused chip was released, with that kind of course bringing a new light to the market, but obviously that comes with great cost, and that also is a limitation for other kind of market competitors to maybe get in the industry and bring down costs and that kind of thing. So the industry has been a kind of interesting level and an interesting area where this is really becoming a mainstream topic, where we're seeing all these AI companies kind of be started up, and we're seeing great developments, but at the same time businesses are worried about the implementation of such language models, and as a result, these tech giants are struggling to sell the language models, with this most specifically being in an effort to encourage the adoption of such AI models by businesses who have deep concerns over costs and the power required to run such language models. Both OpenAI's GPT-4o and Google Gemini's 1.5 Pro have been announced this week and are estimated to have more than 1 trillion parameters. Tech giants are struggling, though, to convince businesses to pay large amounts of cash to run such generative AI products, and also concerns over copyright liability is holding back adoption by many. Therefore, such tech giants are now pitching smaller language models with only a few billion parameters as a cheaper, more energy efficient and customizable alternative, with these models requiring less power to train and also run. Google, Meta, Microsoft and others have all released small language models for this. So this is kind of the key way that these tech giants are dealing with this issue and developing new ways to get around it and still offer this new industry to wide-ranging sectors of business around the world. So great developments are being made, and lots is to look out for within the AI industry at the moment. That's all to talk about in this article, though. Next to talk about is of course to do with the dollar and inflation and interest rates, which is of course something that we've been talking about a great deal recently. I mean, we're always talking about it, of course, because it's very important to us looking at markets from a macro perspective. But of course, this article kind of leads on or follows on from what we were talking about last week with that most recent US inflation rate figure, which did of course show that inflation was now finally on the decline. That said, the inflation figure did come in line with economists' expectations, so we were kind of pessimistic about the kind of change that we might see from the markets as a result of this inflation rate figure. That said, markets have reacted extraordinarily, and we've seen a great sell-off in the dollar, as this kind of talks about, with the dollar, of course, over the last few months rallying greatly as a result of the change in the Fed's rhetoric. So the Fed's rhetoric has been extremely volatile really over the last year, but basically, starting off October of last year, the Fed did start to pursue a far more dovish monetary policy outlook, with the kind of inflation figure readings coming in and showing that inflation was on the decline. And as a result of that, investors started expecting earlier rate cuts and that kind of thing. And the Fed ultimately expected to cut interest rates 3 times this year at 0.25 levels each time. And markets instead were expecting 6 to 7 rate cuts. So the markets were very dovish to do with US inflation and that kind of thing. Ultimately, though, as we've now seen, inflation was not going to act so simple, and instead we've seen kind of inflation prove to be persistent. And as a result of that, basically in March, March period, we really started to see the Fed change its monetary policy once again to one which is far more hawkish, with this kind of with these more recent inflation readings showing that basically inflation is here to stay. And so as a result of that, Jerome Powell and other Fed officials really started to talk less so much about rate cuts and more so about keeping rates where they were, and possibly even increasing rates. With previous to this inflation figure reading, ultimately we were talking of another rate hike this year, and at most one rate cut this year. At least that's what markets were expecting. So a large change. But ultimately, this inflation rate figure that we did receive last week could be telling us now that inflation is on the decline, and this has led markets to really jump onto this idea, with US indices rallying to the upside and also the dollar selling off significantly as the markets do start to price in this change in US economic data. The question will be, of course, though, whether this can continue, as of course the inflation figures that we do receive over the next few months will definitely, and other US economic data will definitely play into the way the markets perceive inflation and the US's monetary policy. Now, the latest inflation figure came after months of higher and higher than expected inflation figures. Recent rhetoric from the Fed previous to this latest inflation figure has led many investors to expect only one rate cut this year, or even a possible rate increase. The latest inflation figure release, however, has shut down those fears, and the dollar is now down 1.4% this month, which points towards the markets finally once again expecting earlier rate cuts from the Fed this year. The key thing is, of course, to note, though, that the markets are no longer expecting another rate hike, and analysts have also been adding to the fire in saying that the recent softening in US economic data could be the start of a sustained period of the dollar weakening. So lots to think about there with the dollar data, but of course, as I said at the start, we need to wait for more data to come out before we can make any kind of assumptions or decisions on the markets to do with this topic. That's all to talk about this on this article, though. Last article to talk about is to do with Gantz and the Israeli government. Now, Benny Gantz has now threatened to leave the Israeli coalition wartime government if Israel does not commit to a new plan for the war with Hamas and its aftermath. This comes in a new act which presents an ultimatum for Benjamin Netanyahu, who is torn by the more left-wing types such as Gantz and the more far-right members of his government, with Gantz saying that if his demands are not met, he withdraw his centrist National Unity Party from the government. He and his party joined the Netanyahu coalition following the Hamas's October the 7th attack on Israel. He has now demanded the government curate a 6-point plan which includes a template for Gaza's post-war governance by the date June the 8th. Gantz's ultimatum is most worrying for Netanyahu because Benny Gantz's party is currently the most popular group in Israel, according to recent polls. Netanyahu's office responded to the ultimatum in saying that Gantz has provided an ultimatum to the Prime Minister rather than an ultimatum to Hamas. Should Gantz leave the government, this would mark the end of the entire cross-party cooperation that has existed since the October the 7th attack. So a very important article there, once again, bringing to light issues to do with world tensions, which have, of course, been pushing world tensions higher as the wars both in Ukraine and in Israel and Palestine have greatly affected, of course, world tensions, pushing the price of gold as well as, other commodities very much higher. In addition to that, things like oil, especially because of its importance within the Middle East and the Middle East significance with regards to oil and that kind of thing. We've definitely seen all the news to do with Israel and the wars in Gaza greatly affecting the market. So that's why this is so important to always note. That's all to talk about in the charts, though. Next to talk about, of course, is the charts, where, like always, we're beginning on the US 30, talking more broadly, of course, about the US indices as a whole, where we do see the US indice, the US 30, the Dow Jones, just holding above this key liquidity zone and key support level, which of course we did note last week as an area which price would interact with and possibly even sell off from. But instead of seeing a sell-off, last Wednesday we saw price break through that key resistance level. And then on Thursday, we did see price hook back as we would usually expect and as we did predict, with price then on Friday interacting with this key liquidity zone and now beginning this move back to the upside. So that was kind of what we were expecting. The question will be though for this week whether we do now see this kind of continuation to the upside, whether we see price push into new uncharted territory and new all-time high levels, as of course that's the kind of key thing to note. And I think the inflation data that we received last week has greatly played into this move to the upside, and as a result any US economic data over the coming week will be greatly important to see whether the US 30 can actually continue this move to the upside, as ultimately whilst price has hooked back onto this area of liquidity, ultimately there's certainly some key kind of resistance levels, psychological levels, which price may sell off from once again, like that $40,000 mark, which of course is a very significant level which price has previously sold off from. And add to that the kind of bearish divergence that we're seeing on the RSI, there's definitely some bearish signals also on the US 30. To talk about next though, of course, is the dollar, which links back to the article that we just spoke about, where of course we were talking about the dollar on the decline. What's interesting to see though is of course over last week, whilst we did see that initial sell-off following that inflation rate figure being released, we did then see price hook back on itself and interact with that 50% Fibonacci retracement level, as you can see here. So price did not make its way all the way back up to that 6180, but it still did make its way up to that 50%, where price is then sold off from, with a bearish engulfing taking out all of that previous bullish price movement. So the question will be, of course, whether over this week price now has the bearish momentum driven by those key news events to push all the way to the downside and make its way down to that minus 27.2% Fibonacci extension level, as that's the kind of key next area on the downside which price could interact with. So that's the key thing to look out for this week on the dollar. Next to talk about though is Euro USD, which like we've seen on the US 30, price has kind of broken above this key resistance level, this key area of liquidity, and has now hooked back like we usually see and interacted with this liquidity level once again, with a bit of slippage of course taking place. Price has now kind of moved above that liquidity zone, but not in a significant enough level and significant enough way for us to say that now we're on the bullish upswing. So we will now have to see whether price can break above this key area of liquidity and likely resistance before price can then continue this move to the upside, making its way all the way up to these next areas of liquidity and resistance, all the way up and around 1.0934. So lots of potential for Euro USD to move to the upside, but as I said, it will be dependent on the economic data that we do receive this week. We're not receiving much Eurozone but some US economic data, so certainly some things could take place for Euro USD to move to the upside. Next to talk about though is pound yen, which is in a very interesting position itself, being in that price is now above this key liquidity zone which price sold off from back last Tuesday, where price did interact with this level, sell off kind of in this retracement form, come very much near this 3820, so arguably interacted with this 3820 level, and has now kind of pushed once again to the upside, broken above this key liquidity zone which price sold off from initially, and is now hovering above that level. So the question will be for this week whether price can continue this move all the way to reach this minus 27.2% Fibonacci extension level, which is near enough around that kind of 198.5 level, as of course the kind of any bullish moves that we do now see on pound yen is kind of moving into uncharted territory, and so we're going to have to form these key areas which price could interact with based off psychological levels rather than previous price action. Next to talk about though is Bitcoin, which is in a very, very, very interesting level, since the price has been kind of ranging around since the start of April or mid-April, and has stayed within this kind of key range which price is now hovering above. After last week, of course, that inflation figure came out that drove a lot of money back into Bitcoin, with price breaking now above this key liquidity zone and resistance level, with price now hovering just above that liquidity zone, and using that liquidity zone maybe to then push higher. So should price now push higher from that liquidity zone, we could definitely be looking at price making its way all the way up to around $71,000 per Bitcoin, which is very significant, of course, but we'll of course also have to wait and see to decide whether that is going to happen or not. And should this be a false breakout, we could definitely see price once again return within this range and make its way back down to those kind of $63,000 a Bitcoin levels. That's all to talk about on Bitcoin though. Next to talk about is of course gold, which has been interacting with these key liquidity zones very nicely recently, bouncing off these key Fibonacci levels and key resistance levels and that kind of thing. And as a result of that, price has kind of pushed, rallied to the upside over last week, and has, whilst did interact with this key liquidity zone and sell off from that level, was able to then find the liquidity around this previous area of resistance and then push higher and break above that key resistance level, and is nearing those previous all-time highs. So Bitcoin is, gold is definitely on the upswing. The question will be, of course, whether price can continue this push to the upside and break above those previous liquidity levels. It'll be interesting to see whether price does hook back and interacts with this key liquidity zone as well, like we've seen on other assets. Lastly to talk about is oil. Not much to say on oil though. Price is still consolidating and waiting around this $84 $84 a barrel level, or $83 a barrel level. So not too much to say on oil. That's all to talk about on the charts though. Lastly to talk about is the economic calendar. We're receiving a great deal of economic data this week, so lots to listen out for. Firstly, we are receiving the Canadian inflation rate figure, followed by that receiving the British inflation rate figure, and then the US FOMC minutes figure. Followed by that, we're receiving the German manufacturing figure, as well as the Japanese inflation rate figure. Followed by that, though, we're receiving the German I just said that, pardon me. Followed by that, we're receiving the German GDP growth rate figure, as well as the US durable goods orders figure, and finally the US consumer sentiment figure. So lots of figures to listen out for this week, lots of economic data, but we've covered lots in the articles, lots in the charts, and lots in the economic calendar. That's all from us at Wildwood Capital. Have a great trading day and great trading week, but I'll see you tomorrow. See you later. Bye.